I want to show you a number. 41,160,000. Say that out loud. 41,160,000. That is the number of physical ounces of silver that have been pulled out of the COMEX registered vault system in a single month. March 2026. 1 month. Now I want you to hold that number in your head while I ask you a question. Curious, what is the price of silver today? 76 hours, down on the day. Red candle. Sell-off narrative running across every finance channel you follow. Here's my question to you. If 41 million ounces of physical silver just walked out the door, if institutional buyers lined up and demanded actual bars, not paper, not promises, not synthetic exposure, actual physical silver, how is the price going down? Surprised? That question is the entire thesis of what I am about to show you. And the answer to that question is the most important thing happening in the commodity markets right now. The two markets you do not know exist simultaneously. Most people watching a price chart believe they are looking at one market. They are not. They are looking at the output of two completely separate systems that share one number, the price, but operate on entirely different logic, respond to entirely different inputs, and are currently moving in entirely opposite directions. System 1 is the paper market. The COMEX silver futures market processes roughly 250 million ounces of paper silver every single trading day. Let me be clear about what that means. 250 million ounces of buy orders and sell orders moving through the exchange in a single session. The United States produces approximately 1 million ounces of silver per day from all active mining operations combined. The paper market trades the equivalent of 250 days of American silver mining production, every single day. The participants driving that volume are not silver miners. They are not solar panel manufacturers. They are not central banks accumulating physical reserves. They are algorithmic trading systems, macro hedge funds, commodity trading advisors, and short-term speculative accounts running strategies that were written in response to dollar movements, interest rate signals, and geopolitical headlines. When the Federal Reserve makes a statement, algorithms read the language, identify the macro implication, and execute silver futures sell orders in milliseconds. The silver sitting in a vault in New York is not consulted. The procurement schedule of a Chinese solar manufacturer is not referenced. The delivery notice data from the CME depository report is not an input. The paper price falls. The algorithm moves on to the next trade. System 2 is the physical market. A solar panel manufacturer running production lines in Jiangsu Province, China, has a procurement contract specifying exactly how many ounces of silver will be delivered to their facility each week for the next 18 months. That quantity is not a negotiable variable. It is embedded in the engineering specification of every photovoltaic cell they produce. When the Fed holds rates, the factory does not pause. When the dollar firms up, the silver per cell does not change. When algorithms sell futures at millisecond speed, the production line continues at the same pace, consuming the same quantity of silver. These two systems are running simultaneously right now under the same price tag. And right now, in March 2026, they are telling the exact opposite story. The ledger, what the data actually says. I am going to give you numbers now, documented, public record, CME data, verifiable by anyone. March 2026, COMEX Silver Registered Vault. Opening inventory, under 80 million ounces. Delivery contracts standing for physical metal, 8,232. Each contract, 5,000 ounces. Total physical delivery in March, 41,160,000 ounces. That is more than half of the entire registered inventory of the COMEX silver market extracted through physical delivery in one single contract month. Now here is what makes that number structural rather than just large. This is not the first month this has happened. This is month 6 of a consecutive delivery cycle where physical extraction has exceeded historical norms. The total silver that has departed the COMEX ecosystem, not moved between vaults, not rolled forward, actually left the system, over this entire delivery cycle is 187 million ounces. 187 million ounces gone from the COMEX system. The LBMA vault ratio has fallen below 3-to-1. The Shanghai Futures Exchange silver inventory is sitting at 11 million ounces. Every major exchange system globally is draining simultaneously, and standing above all of that, above a registered vault that will have approximately 65 to 75 million ounces left by April 30th, is the May open interest. 380 million ounces. 380 million ounces of paper claims. 70 million ounces of physical inventory. 43 days until first notice day when those two numbers have to face each other. That is the arithmetic. That is not a forecast. That is not an opinion. That is division. 380 divided by 70 is 5.4. For every physical ounce of silver in the registered COMEX vault right now, there are 5.4 paper claims on that ounce. And the clock says April 30th. What JP Morgan did yesterday and why it matters more than the Fed. Yesterday, while every finance channel was running wall-to-wall coverage of the Federal Reserve rate decision, something happened in the CME delivery system that received zero headline attention. Morgan Stanley issued 157 delivery notices. JP Morgan took 100 of them. 100 contracts, 500,000 ounces of physical silver. JP Morgan committed to receiving actual bars into their vault from Morgan Stanley on the same day the paper market was in full sell mode. Now I need you to understand who JP Morgan is in this market. JP Morgan is the largest single custodian of COMEX silver inventory in the world. JP Morgan is the authorized participant for the world's largest silver exchange-traded fund. JP Morgan has more complete, more granular, more real-time operational knowledge of the COMEX silver vault system than any other entity on this planet. This is not a retail investor averaging down. This is not a small fund making a contrarian bet. This is the most informed participant in the room. The institution that reads the daily vault reports, monitors the delivery notice flow, and runs the May open interest math against registered inventory every single morning, choosing to take physical delivery of 500,000 ounces on the day the paper market was pressing the price lower. Ask yourself this one question. If JP Morgan, with all of that information, believed that today's paper price decline reflected a genuine deterioration in silver's physical value, would they be standing for 500,000 ounces of delivery? That is not the behavior of an institution that thinks the price is heading lower. That is the behavior of an institution that thinks the price is significantly below where the physical data says it should be, and they have the data to know the difference. How the same institution is on both sides, and why that is the signal. Here is something most retail market participants have never been shown about how large financial institutions actually operate in a commodity market. JP Morgan does not have one silver strategy. It has multiple desks with multiple strategies running simultaneously. The macro trading desk reads the Fed statement. It models the implications for the dollar, for real rates, for precious metals positioning. It sells silver futures contracts. That selling contributes to the paper price declining today. The macro desk is doing its job correctly. Simultaneously, the physical commodity desk reviews the CME delivery data. It calculates the May open interest ratio against projected registered inventory. It reads the departure figures. It checks the Shanghai premium. It runs the April 30th math. And it concludes, physical silver is worth more than the paper price currently reflects. Stand for delivery. These two desks are not in conflict. They are executing two strategies with two different time horizons. The macro desk captures short-term volatility. It profits from the paper price movement today. The physical desk captures long-term structural value. It accumulates real metal at the price the macro desk just helped create. The paper short and the physical long are two sides of one institutional strategy. And the net result is that the most informed institution in this market is using today's paper sell-off to accumulate physical silver at a lower price, while everyone watching the paper price decides whether to exit. That is not a conspiracy. That is not a scandal. That is institutional precision operating in a market with an information asymmetry between participants who have access to delivery data and participants who only see the paper price. The delivery notice entered quietly into the CME record yesterday is the signal. Not a press release. Not an analyst note, a 100 contract delivery notice on the most confusing trading day of the month. The Shanghai premium, the gap that cannot close. There is a price for silver in New York. There is a price for silver in Shanghai. They are not the same price. The Shanghai Futures Exchange silver price is currently trading at a substantial premium above the 76-hour COMEX paper price. That spread represents an arbitrage, a profit opportunity that should, in a normal functioning commodity market, attract supply from lower-priced regions to higher-priced regions until the spread closes. It is not closing, because China's export controls have effectively blocked the conventional arbitrage mechanism. The silver sitting in COMEX vaults cannot be shipped to Shanghai at the speed and volume required to equalize the two prices within the regulatory framework that now exists. The arbitrage is real. The mechanism to close it is blocked. What this means for every institutional buyer operating through the COMEX delivery system right now is this. They are accumulating physical silver at paper prices created by macro-driven algorithmic sellers knowing that the physical market in the world's largest silver-consuming economy is pricing that same metal significantly higher. The basis, the spread between paper and physical, is not narrowing. It is widening. And when the paper price eventually reflects the physical scarcity that the vault data documents in real time, the basis resolves in one direction. The direction has been set by 187 million ounces leaving the COMEX system, by 11 million ounces remaining in Shanghai, by a registered vault heading to 70 million ounces by April 30th. The direction is not a question, the timing is the only variable. The gold-silver ratio is telling you something the paper price is not. Right now, gold is trading at 4,853, silver is trading at 76. The gold-to-silver ratio is approximately 63.8. The historical average gold-to-silver ratio, measured across decades, sits between 40 and 51. Take today's gold price. Apply the historical mean ratio. Silver's implied price range is $97 to $121 per ounce. The current paper price of $76 represents a discount of $21 to $45 per ounce against the price implied by the historical relationship between these two metals at current gold levels. This is not the only time silver has been at this kind of discount. Before every major repricing in this cycle, the ratio has been extended at exactly this type of reading. Silver fell from $121 to $70 in February. Physical buyers appeared at $70 and drove it back toward $90. The ratio compressed. The paper price followed the physical buying pressure. Now the ratio is extended again. Now physical buyers are standing for delivery again. Now JP Morgan is taking 500,000 ounces into their vault again. The pattern has repeated at every significant dislocation in this cycle. The driver of the pattern, the vault drain, the delivery arithmetic, the Shanghai premium, the departure figures, none of it changed because of today's paper selling. It tightened because of it. Every ounce delivered at $76 instead of $90 is an ounce accumulated at a discount that the May arithmetic will eventually close. April 30th, the date everything converges, April 30th, 2026. That is the first notice day for the COMEX Silver May contract. On April 30th, every open interest holder in the May contract must declare physical delivery or roll forward. Currently standing above a registered vault projected at 65 to 75 million ounces on that date, 380 million ounces of paper open interest. The COMEX system has always relied on a behavioral assumption to manage this math. The assumption is that the overwhelming majority of paper holders will choose to roll their positions forward rather than stand for physical delivery. This assumption has historically held because most paper market participants do not want silver bars. They want price exposure. But that assumption depends on trust. Specifically, it depends on the trust of every paper holder that when they eventually do want physical delivery, someday in the future, the metal will actually be there. 6 consecutive months of delivery demand exceeding historical norms is degrading that trust. The departure of 187 million ounces from the COMEX system is degrading that trust. The LBMA ratio falling below 3 to 1 is degrading that trust. Shanghai sitting at 11 million ounces is degrading that trust. Every institutional risk manager who reads the CME Daily Bulletin is reading the same numbers you just heard. And the question, every one of them is running through their models right now, is not whether to roll. It is whether rolling forward to a later delivery date still guarantees the metal will be there when they ask for it. The moment enough of them conclude the answer is no, the delivery demand for May accelerates. The vault heading to 70 million ounces cannot satisfy 380 million in paper claims if the roll rate assumption breaks. The math produces one outcome. April 30th is the date. The variable is how many paper holders have run the same arithmetic I just showed you. What today's price action actually means. Here is the complete picture of today. The paper price fell from $77 to a session low of $74.89 before buyers stepped in. It recovered to $76.08 by session close. The decline was driven by real macro inputs. The Federal Reserve held rates at 3.5 to 3.75%. Inflation remains elevated. The Strait of Hormuz situation is intensifying. Oil is higher. The dollar is firm. The 10-year Treasury yield is near recent highs. The paper market translated all of that correctly into one conclusion. Precious metals face near-term headwinds. The paper price declined accordingly. That is not wrong. It is accurate within the paper market framework. Here is what it missed. While the paper market was selling, The physical delivery demand floor did not move. Solar manufacturers consuming 200 million ounces of silver per year globally did not pause procurement because of a Fed statement. Their factories ran at the same production rate, consuming the same quantity of silver, scheduled months before today's announcement. While the paper market was selling, J.P. Morgan was standing for 500,000 ounces of physical delivery from Morgan Stanley, because the most informed institution in this market concluded the physical metal is worth more than the paper price reflects. While the paper market was selling, the registered vault continued its directional drain toward the April 30th confrontation with 380 million ounces of paper above it. Today's paper selling did not add a single ounce to the registered vault. It did not reduce May open interest. It did not alter one industrial procurement schedule. What it did was lower the price at which the next round of physical accumulation occurs. The paper sell-off today did not damage the physical silver thesis. It funded the next phase of it. This is the full picture. Silver at $76.08. Paper narrative pointing lower. CME delivery ledger. 41.16 million ounces physically extracted in March alone. 187 million ounces departed the COMEX system through this entire cycle. Registered vault heading to 65-75 million ounces by April 30th. 380 million ounces of paper sitting above that vault. 43 days on the clock. J.P. Morgan, the most informed participant in this market, took 500,000 ounces of physical delivery on the most confusing day of the month. The Shanghai premium remains open. The arbitrage mechanism is blocked. The gold-silver ratio implies silver is trading at a $21 to $45 discount to its historically normalized price against current gold levels. The paper price is the story the financial media covers. The delivery data is the story that determines what happens next. They are not the same story. They have not been the same story for 6 months. And on April 30th, the math decides which story was right. If this breakdown gave you the physical picture behind today's paper narrative, subscribe. Every delivery cycle, every vault shift, every notice that the headlines miss, we cover it here. That is the work. I will see you in the next one.